more refined somebody is in what they do, and the longer they've done it, the less risk you have investing your money with that person.
Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
Right. Welcome back to the Gentle Art of Crushing It Passive Investors Edition podcast. My name is Randy, and I will be your host today. And we have got a really, really fun podcast guest with us today, Roger Becker. Roger is a passive investor. A large portion of his monthly incomes comes from this space, and I think he's going to bring a tremendous amount of value to the audience. So, Roger, welcome to the show.
Thanks, Randy, and it was so great meeting you a couple weeks ago. It was the highlight of the conference for me, and I am one of your fans.
I appreciate that, Roger. Thank you. And actually, likewise, we kind of talked a little bit. We spent a little bit of time at that conference, and then I think it was like day 2 where we met for breakfast. And I would agree that was the highlight up to that point, and it really kind of helped set the stage for the rest of the event for me. So thank you for that. Well, why don't we jump right in? Can you tell the audience a little bit about your background, about yourself, and kind of how you found that passive investing space?
Sure. So about 25-ish years ago, no, more than that. So about, between 25 and 30 years ago, one of my best friends at the time was a real estate. He was a broker in San Francisco where I lived at the time. And then he was investing in his own buildings, apartment buildings, in the Tenderloin in San Francisco, Nob Hill Tenderloin. And, the notion of passive income I learned from him, and it sounded like the holy grail of all of life to me when it was explained, and it didn't take long to understand. And so from that point forward, and that was in 1998, I have been intrigued by it, the notion of not having to work ever since.
Are you interested in real estate investing but don't know where to get started or think you don't have the time or money? Are you stuck in your W-2 because the golden handcuffs make it hard to walk away? If this sounds like you, check out impactequity.net and schedule some time to talk with the founder, Randy Smith. Randy went from massive income to leaving his W-2 through passive income, and he can help you do the same. www.impactequity.net.
Okay. Yeah. So it's funny you say that. I think a lot of people hear, or at least the first time I heard about passive income, being a perennial lazy guy, like the thought of sitting back and watching the checks coming in, that sounds really, really attractive to me. So I'm curious, with 25 years of experience, is it really that easy? You just send a check and next thing you know, you're getting checks for the rest of your life and you're financially free?
Yeah, that's a really smart question. No.
Right.
Yeah. I've been really spending a lot of time, like more than in the past. I've been spending a lot of time really focusing on passive investing in the last few years. And it takes knowledge, it takes skill, it takes research, it takes patience. And, the reason that is that a lot of people that are raising money for syndications for somebody like you or me, Randy, or anybody else to invest in, there's maybe thousands of them, and certainly hundreds, but probably thousands. And, it's just, look, they used to talk about the 80% rule in sales. And I know you come out of the sales background, from a sales background yourself, as do I. And the 80-20 rule is that 20% of people make 80% of the money. Now, it could be argued that 10% of the people make 90% of the money, but it's a commentary on competence. And I think it applies across the spectrum of everything. And so this is maybe me being cynical, but I think 90% of everything sucks. So whether it's movies, restaurants, people, et cetera, et cetera. And I think this also applies to people that you would invest in. And so if those numbers are right, and I'm not saying that they are, that means there's a 90% chance that you're going to invest with somebody that doesn't know what they're doing. And so to separate the wheat from the chaff and get to that 10% takes a hell of a lot of work.
Thank you. I feel like we could drop the mic right there and move on, and the point would have been made. But the fact that and I've shared this before, and I try not to be cynical as well, but anybody with 20 grand can go to a guru weekend and call themselves a syndicator, and then the next day start raising dollars for a deal of which they might have seen on a presentation, or they might have read a book or a deck, but they don't have any real life experience operating the business plan that and not just operating, but operating with like superb efficiency and effectiveness in order to generate the returns that quite often they are suggesting on their performance. So yes, I'm glad that you bring that up, and I think that probably identifies, or at least identifies a need for a superpower of vetting operators, which I know with your experience, you've got a lot of skill in that space. So can you walk us through that journey? I mean, 25 years ago to 30 years ago to a buddy in San Francisco doing this to where you are today, a lot of education has occurred there. So what have you done to become good at vetting operators?
Well, I wouldn't say I am good at vetting operators. I've gotten better, but I've made, I invested with an operator, geez, as recent as a little over a year ago on an assisted living project that I stand to lose a fortune on that by not vetting. So I don't claim to be good at it. But what I'm trying to do, so to digress for a minute, am in the advertising business, and for the first 13 plus years, I scraped together a living, and sometimes I didn't scrape together a living. So I went from not scraping together a living to scraping together a living. But when I identified a very tight niche, that was underneath the radar, then I hit the ground running, and I leveraged everything I knew up until that point, and I ended up doing really, really well. So now I am looking for people in the real estate space. And it doesn't have to be real estate, but most of the alternative investment space is real estate. I am looking for people that do one thing only. One of the great quotes I've read in the last year or so is, I am looking for somebody that has done one thing 10,000 times. I'm not looking for somebody that's done 10,000 things. And so if you find somebody that all they do is one thing and that's it. So it could be, it could be mobile home parks. It could be neighborhood retail. It really doesn't matter what it is, but that's all they do. And then ideally, if they only do it in one market, which is not always easy to find, but the more refined somebody is and what they do, and the longer they've done it, the less risk you have investing your money with that person. Um, and I can't speak enough for time. And I'm talking to myself here and anybody that's listening, or your listeners. I thought, even once I found the niche in my own business, a couple years into that, because I was confident and, and had some arrogance. I thought I knew everything. But if I look back now at what I knew then, I didn't know anything. And so when I look at somebody that's, been doing multifamily or whatever the heck it is, and they've been doing it for 3 years, I'm like, not that it's a hard no matter what, but I got to tell you, I want the guy that's been doing it 20 years, because this stuff's complicated. and there's a ton to know. And so, you and I have worked hard for our money. It's once you lose it, it's hard to get it back.
Yeah, that simple process of the 10,000 hours, I think that's, or 10,000 times you mentioned, and I've heard the 10,000 hour analogy. And I've heard people just recently start talking about like 10,000 hours might not even be enough. Like you can become very skilled at a trade, but are you truly a master at 10,000 hours, which in real terms, that's 40 hours a week for 5 years. So, to take it one step further to your 20-year example, we're talking 40,000 hours
Right.
need to be spent in order to hit like true mastery. So, and I will say, if you set that as your guideline and you set that as the yardstick to measure your operators against, there are not a lot of folks out there that have been doing that for even, let's call it 10 years, let's be honest, or importantly, 12 to 15 to get back beyond, the 2008 crisis that we all went through. So I'm curious, when you mentioned earlier the assisted living space where you invested some dollars and that might not go as you had hoped that it would, what kind of lessons did you take from that, and how are you taking those lessons into future due diligence process?
Yeah, good for you, Randy. Good question. Um, I should have known and I didn't, because this is a year ago, December. The person I invested with really, and I didn't even have not the knowledge or the background to, because again, even though I've been screwing around with some of this stuff for 25 years, I've been really getting active in the last 2 to 3. First of all, the guy that I invested with really at the end of the day was really just raising money. He wasn't going to be the operations guy. And and the day-to-day guy had no experience either. It was like tangential. And so it was just, honestly, it was just stupid on my part. So don't invest with people that don't have the experience.
Yeah,
That's it.
gosh, amen. And I think back to the times that I've been burned on deals, and it's odd for me to say this as a sales guy, but 9 times out of 10, when I have been burned, um, I fall victim to the charismatic sales guy. And, for some reason, all logic seems to leave me when I am excited about an opportunity. And I've had multiple, like, let's call it 3 in the last 6 to 7 years, where um, I had an opportunity presented to me. All things are saying, let's do more due diligence. And yet I wave it off because I feel like I know I can trust this guy. So, it's interesting. They say that investors invest primarily based on emotions, and myself included, and then we find logic and data to support our emotions. Um, and that that will be the end of me if I don't figure out how to kind of reverse that. I think on the other side. So,
Well,
any thoughts about that?
well, no, yeah. I mean, you were very astute, because I don't even think I said that, but you read between the lines and you hit the nail through the board. I fell in love with the sponsor, and I met with him. I started investing with him in multifamily, and I went to visit one of the properties a couple years ago when he was going to be there, and his other partners, and just fell in love with these guys. I trusted them and liked them, and yeah. And now I'm paying the price. They didn't have the experience. End of story. And it's funny because even the multifamily I invested with them, looking back, they didn't really have that much experience doing that either. And I just didn't have the frame of reference at that time, as you know, because you've been a guest on my podcast. Through my podcast over the last couple of years, that's how I'm learning all this stuff. And I mean, I wouldn't put another penny with those guys. Talk to me in another 10 years. And the other thing is, here's another thing I learned too, by the way, again, is that when I started investing with these guys, they weren't even a partnership. They were 3 guys that came together and were partners on this deal. Like, you never do that because one of the big risks in these things is partnership risk. What happens when the partnership implodes, which they do often? So since then, they've coalesced and created a company, which that's just luck. And on the multifamilies, I'll probably do okay. I don't know if I'm going to lose money. I might make a little bit of money on one. And I might, you know what, by the way, I might come out okay on the assisted living facilities. I tend to have a very strong negative bias because that's just me. Uh, but I no, I mean, you got to find people, that have a ton of experience. Ideally, they're referred by people that have done business with them for a long time. So somebody goes, "Oh yeah, I just invested with those guys 6 months ago, and they're just great." That has no value. If they've been like, yeah, I've been investing with this, I've been in 10 of their deals for the last 10 years. And even then, what I don't like even about 10 years is the last 10 years has been halcyon days of both equities and real estate. And even that I'm a little bit jaundiced as well. If it's 20 years, then I'm like, okay, that means something.
Yeah.
Yeah.
Yeah. Very good. Very good. I love everything that you share, and I think that's why we connected so much. Like your experience with your real life examples of the things that you've seen in the space that are just super, super valuable. So thank you for sharing that. So now, so we both kind of alluded to the fact that last 3, 5, 10 years have been um, a lot of fun. If you're throwing money at anything, it's been a lot of fun, and pretty much anybody with a pulse could make money in the market over the last 10 years or so. So we've transitioned into a new phase or a new portion of this cycle. As Jim Rohn would say, we might be going into the wintertime season. I'm curious what your thoughts are on what we could expect to see, or what you think we might see in the coming 6 to 12 to 18 months. Let's talk, if we can, specifically in the multifamily space.
Okay. Well, the qualifier here is that I only know what I read and what I hear from anybody else. So I'm just going to regurgitate, the same stuff you have access to. But specifically as it relates to multifamily, there is, I think, 30% of the acquisitions done in the last couple years, I believe, were done with bridge debt, which is very highly leveraged, debt. 80% it could be borrowing 80%, and short term, and it could be an initial term of even a year, it could be a year, 2 years. And then in order to get an extension, you first of all you buy rate caps, so you're hedged against the rate going up beyond a certain amount uh, after that first initial term. You know this stuff, Randy. Some people didn't even get rate caps, which is just people not knowing
Scary.
what. Yeah, and it's people not what they're. This is probably what I would have done if I were like doing multi. Um, so, but here's the thing: is even if you do have you did buy a rate cap, there's covenants in there. You've got to meet certain metrics in order to get the extension. And debt service coverage ratios and other metrics. And that conference you and I were at, it said 23%. One of the gentlemen speaking, Bob Fraser, said 23% of according to Fitch, I think is Fitch Ratings, says 23% of the borrowers aren't going to be able to get refinanced. So I think what's going to happen is it's going to be a great time for buyers. I hear that already, prices on C class, maybe B class assets, maybe B not as much, but probably depending on the market and the asset, are already down 20% from their peak. In that case, if 20% was, common equity, guess who just lost all their money is common equity LPs. But if you're buying, there's going to be opportunities, but it could be a real bloodbath. That's what I think. So if you have liquid, you're lucky.
Yeah, yeah. No, there's definitely a lot of folks are very concerned about this. I think if you're on the buying side, you're probably pretty excited about this. What I've heard in recent weeks is that um, prices, while they are coming down, they probably still are not aligning with buyer sentiment. So there's still a fairly large gap between the two. Um, and ultimately what that'll lead to is less transactions occurring, which I think I saw a stat yesterday that over a 70% decrease in the number of transactions have occurred in January compared to a year prior. So it just means that the deals that are out there and are available are competing for the same investor dollars if those investors haven't put their dollars on the sideline. And it makes it very, very competitive. So I think it's going to be interesting to see. Now, I did hear something just recently as well where they were talking about some new debt tools that could be coming out to help jump in and save the day. I get a little concerned when I start hearing about banks coming in to save the day. Maybe I've got a little bit of um, trauma from 2008, I guess. But nonetheless, it's going to be an interesting 6 to 12 months for sure. But I think we hear me being the eternal optimist and glasses half full guy. I think there's always opportunity. So I guess between you and I, glass half full and half empty, we've got a full glass between the
Yeah,
two of
right.
us. So that's good. So let's do that. Now, what are you doing with your investor dollars at this point? Or your investment dollars? Are you still placing capital in deals? Are you sitting on the sidelines? Are you trying to keep some dry powder there? Like what is your strategy at the moment?
Yeah, no, really. I haven't been a guest on too many podcasts. I'm always the one asking the questions. So I got to tell you, it's just such a good question. You're doing a great job. Um, yes and yes. So yes, I am sitting on the sidelines, and yes, I'm investing. So,
Okay, very good, very good.
and it's just
Yeah,
very, I am very seat of the pants. I'm very unsophisticated, so I don't have a plan. And so, the generous description would be opportunistic. And so, I have, I think this year upped a commitment I made last year with a guy that all he does is neighborhood strip centers, and there's all in the Bay Area where I live. And I found him on Twitter, and he's been doing it for 20 years, and got uber comfortable with him. And I think that there's been virtually no new construction of this asset class in the last price well since '08, '09. And a lot of those tenants, it could be a massage parlor, it could be a restaurant, it could be a hair salon, any number of things that just aren't going away, and need, they need that space in order to remain in business. So I think it's a more resilient asset class, I think, than a lot of people are aware of. So no, I'm just, and yeah, so, and I'm lucky. I do have liquid, and I'm anticipating as again with multifamily, but maybe in other asset classes as well. I'm anticipating the market coming down. So I'm just really waiting and seeing.
okay. No, I like that. I like strip centers. You and I were both at the same conference, so we heard the same advice of non-grocery
Right.
anchored centers specifically because with Amazon and Whole Foods coming into play and a lot of the delivery tools that are out there, that is no longer the kind of the guaranteed returns that carry the whole strip center. So that's interesting, and I agree with you in that personally I like to be able to go drive a property that I am personally invested in. Um, in my neighborhood, and specifically, I like to go out and just kind of walk the grounds and see what is the property manager doing there? Like, is there anything that looks alarming to me? Um, and it's in the market that I know best ultimately. So I would agree. I like strip centers. I like them in my hometown. I've not invested in that space yet, but it's something that I'm looking at. So good stuff. Now, I'm curious, and this is a little bit of a tangent, but I talk to a lot of investors that, they've got 401k money or they've got money in the stock market. And as we all know, we've all been hurt if we're in the stock market in the last, call it 12 months or so. And the standard question that comes up is, or the fear, I guess, is that they don't want to pull their money out of the stock market today because they've already lost a bunch of money. They want it to go back up before they pull their investments out. Do you have any thoughts about that strategy or that fear? And do you struggle with the same thing?
Yeah, I listened to a podcast. It's funny you asked that question. It's so timely for me. Is I listened to a podcast last weekend, and I don't remember the names of the guests, but kind of heavyweight kind of folks, and they believe that the stock valuations right now are even with the contraction of last year, that they refer to them as hideous valuations, and that the valuations are what they were before 1929 right now. So it's a way of kind of saying that, as much as somebody's lost, that they could lose and will lose a hell of a lot more, um, generally speaking. But I mean, I am so unqualified to talk about the stock markets. I mean, I'm just repeating what I've heard. And then I read a book. I was listening to a podcast. They were talking about this book that I can't remember the name of. Yeah, oh boy. Oh gosh, I wish I could remember the name. It doesn't matter. But anyway, what they're saying is that all the gains we've seen in this country in real estate and the stock market, just overall in the last 40 years, are all because of quantitative easing. It's all because of the interest rates going down. End of story. Not and not because of increased production. We have not become more productive. We're just printing more and more money. And so they believe that in what they're saying in this book, the premise is this, is that as long as and it's amazing because it was written like a year ago, and it basically said, as long as there's no inflation, the party can keep going forever. That's true. But at some point, there's going to be inflation. Now, what was so amazing is that this book was written a year ago before the inflation of the last year. So I'm reading it going, these people know what they're talking about. It's like all of a sudden there's major inflation. Just this morning in the Wall Street Journal, they're saying, oh, that January's been there's been a great month in the stock market, with last month. NASDAQ and the S&P have both done extremely well. But that's largely because there's investor sentiment that the Fed's not going to continue to raise rates and what have you. Again, all I know is what I read, but I look at that and I'm going, they could be totally wrong. And I'm sure there's a lot of people that know a hell of a lot more than I do, or a lot smarter than me, that think they're wrong. So I'm giving you a huge I don't know, but I mean, the other thing is this, and here's another thing in this book, is they say that, that everybody kind of goes, hey, you know what, it'll come back. It always comes back. And they're saying that it has, but not necessarily. And the podcast I listened to last week believes that the S&P is going to come down dramatically. It could come down as much as 50%. And they're saying, and it might not, they're not saying specifically it's going to, they're saying it could, but what they're saying is whatever it comes down to because of valuations, they're saying it's not going to come back for a decade. So if you're in your 30s or 40s and you're making a lot of money, you're probably fine if you don't need your money for another 20 years. But if you're my age, that's a different story. I mean, I don't need the money to live on this second, but I don't want to lose it.
Of course.
So, I don't know.
Yeah.
Long answer.
No,
sorry, Andy.
No, thank you for that. I think it's something that I think is top of mind for a lot of people right now. And you give it a different perspective. And certainly a very humble answer. You keep sharing how you're not an expert, you don't have the knowledge, and yet you continue to share amazing information that you've learned along the path. So um, I appreciate the humble presentation of it, but there's a ton of knowledge and experience there that I think our guests are benefiting from. So thank you for that.
Let me add one quick thing, and I appreciate those words.
Yeah,
I do, um, because it is relevant to your question. Is this one book that was written, which I can't remember the name? They're saying
sure.
it's been rates coming down. Basically, it's quantitative easing. This is why the stocks have gone crazy. So
Yep.
they're saying that now with inflation is driving down. I'm sorry, interest rates have
Yep.
driven the prices down. But they're saying that now we're going to get into um, the earnings of these companies. If we hit a recession, the earnings of these companies are now going to come down, and valuations are going to come down. So we've just hit the tip of the iceberg. And
Yep.
again, as I'm not sophisticated, but I can understand that, and I'm like,
Yep.
yeah, I get it.
Yeah, and for the audience, we're recording this in early February, and it will probably be a couple of months before this is aired. But I just saw a headline this morning that talked about the big three tech giants, Amazon, Google, and whoever the other one was. Like all three of them reporting decreased earnings last year for Q4, and preparing for a year of 2023 of tightening the belt, essentially. So, what these folks in the book that you're referencing were discussing a year ago has actually started to trickle down to the real numbers. So interesting stuff. Yeah, I think it's kind of, I keep coming back to this over and over and over again, but it's like the next 6 to 12 months are going to be extremely important for the new passive investor, the existing passive investor, and certainly for the folks that have all of their net worth tied up in the stock market. So the argument that I've shared with people as well is, let's say we're down 20%. In the very best of situations, people could get that 20% back in the next year or maybe 2 years. Very, very best, very optimistic view. Whereas a lot of these deals in the multifamily space, if performance run true, you see 16 or 17% IRR per year. So fast forward a few years, my belief is dollars in good syndications with excellent operators are much better suited to be sitting in those syndications than they would be staying in the stock market praying to get those returns back. But we'll have to come back in a year or 18 months and see what it is. But that's my forecast. I'm putting it out there. So.
If there's always there's always inefficiencies. So and there's a zillion apartment complexes out there if we're talking multifamily. So if you get somebody that found a great deal that's it's 30% under market rent, and let's say doesn't take too much capex, and they found a diamond in the rough because they have a huge presence in a market and they're dialed in with the broker community, blah blah blah. Absolutely,
Right.
sure.
Right. Lost to lease, great financing, good
Yeah.
operator, all of those things. Yep, absolutely. But it's probably not the guys coming off of the weekend conference that just spent their 20 grand on the guru that are going to be the ones to get it done. I don't think. And I feel like I'm sharing that too loudly lately, and I'm probably offending a lot of those folks. But my dollars are just too precious to me, and my investors' dollars are too impressive or too important to me to throw them around anywhere. So, anyways, well, let's do this. We're actually over the 30 minutes that I normally allocate to these. What I think, Roger, is we're probably just going to have you come back so we can continue this conversation sometime in the future.
Okay.
But I really, really enjoy the level of education and expertise that you have in this space, albeit humbly presented. I think you brought a ton of value here today. So I'm curious, for our listeners, where can they get more Roger Becker? How can they hear more about you?
Gosh, well, my podcast, Street Smart Success.
Yeah.
That's where you hear. I mean, you'll hear from my guests. I ask the questions, but you'll learn a lot. If anybody wants to get a hold of me, uh, probably email is best. rbecker@beckermedia.net.
Fantastic. Well, Roger, thank you so much for coming on the show today. It's been a pleasure. I appreciate the friendship and the conversations we've had up to this point. So thank you so much for being on the show. I really appreciate it.
You got it, Randy, and look forward to it again. Okay.
Awesome. All right. And to our listeners, as always, I encourage you to continue to get educated in this space, continue to watch folks like Roger, connect with Roger, and continue to get inspired. I'm very confident that once you jump into the passive investing space, you'll see all of the benefits that both Roger and I have, and you'll continue to come back to the space for years and years again. So thanks so much for listening today, and we'll look forward to having you on another podcast. Thank you.
Well, there you have it, ladies and gentlemen, another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.